Hello and welcome to today's episode of DIFC Unplugged. My name's Jonathan Beardall. I'm the Head of Wealth and Asset Management for the DIFC Authority. Today I'm delighted to be joined by Louis-Vincent Gave, the CEO of Gavekal Wealth, and we're going to talk through your outlook for 2025. So, thank you for being with us today. A real pleasure to have you here. For those listeners and viewers who are less familiar with the firm, could you give us some background on Gavekal Wealth?
Absolutely. Well, first of all, thanks so much for having me, Jonathan. It's a pleasure to be here with you in Dubai today. Gavekal started 25 years ago. We started initially as a research firm in Hong Kong, really focusing on developments in China. And then the firm grew in different directions. We built an asset management arm. About 15 years ago, we bought a stake in a private wealth business in Seattle. And to be honest, with the benefit of hindsight, that was a typical case of being lucky rather than good. We happened to invest in the part of the world that basically boomed the most. If you look back at the past 15 years, Seattle means Microsoft, it means Amazon, it also means Costco, Expedia, Starbucks, you name it. So many, to be honest, blue chip names in that region. So our private wealth arm did very well. And, on the back of this experience, we thought, okay, what is the big story of the next 10, 15 years? As a firm, we're very convinced that the next 15 years is really the broader growth around the Indian Ocean. And so we had the opportunity a couple of years back to buy a private wealth business in Mauritius. So we bought that. And from that, using that as a bit of a bridgehead, we decided that having an office here in Dubai, which is sort of the true heartbeat of the Indian Ocean, made perfect sense. So here we are. We now have an office at the Dubai IFC. Thank you very much for hosting us. And looking forward to what the region will deliver in the coming years.
Fantastic, thank you. And look, I'm going to go straight into it. Let's look at 2025. 2024 is nearly finished already. Unbelievable. A quick question, Bondz or gold?
So I'm French originally, and I grew up going to a Jesuit school. When I was a kid, we had a very charismatic priest and teacher, and one of my friends egged me forward and say, go ask Father Michael if it's true that Jesuit priests always answer questions with another question. And so I asked him, he looked at me and he said, who told you that? And in this spirit, I'll reverse the question and say, when you say bonds, what bonds do you mean? And I think this is actually a super important question, because for me, the biggest macro trend in the world right now, perhaps that most investors are underestimating, is the extent to which China is leapfrogging the West in industry after industry. I think here, frankly, in Dubai, you've got front seats to this development. You walk around the streets and all of a sudden there's Chinese cars everywhere in a way that, wasn't the case 5 years ago. If you're putting solar panels on your roof, they're going to be, chances are they're going to be Chinese-made solar panels, since something like 93% of the world's solar panels are now made in China. But it's not just that, it's, railroads, nuclear power plants. China, as we speak, is bidding to build nuclear power plants in Saudi Arabia. As a Frenchman, this blows my mind. I think I would have never bet on that just 3 years ago. So the reason I highlight this is that as China moves up the value chain in industry very rapidly, there's really two kinds of reactions a country can have. The first kind of reaction is the reactions that we're seeing in Saudi Arabia, in the UAE, in Indonesia, in Chile, in Mexico, where when China comes and says, hey, do you want a cheap car? You say, yes, please. Sounds great. Thank you very much. I'll take two. The other option are countries like US, Canada, Europe, that say, you know what, I can't handle the deflation coming out of your industry right now. I'm going to put up huge trade barriers. I'm going to put up tariffs. And the reason this matters is that if you think of the past 30 years, China has been the biggest deflationary force for the world. So if you now have countries that say, I can't deal with this deflationary force, I don't want any, then those countries are de facto going to end up with higher inflation rates. And so I would say that when you think of bonds, for me, the bond markets are going to break into two parts. The parts that welcome trade with China, which is mostly emerging markets, plus a few developed markets like Australia, New Zealand, And in those countries, you can own the bonds. And then there's the countries that reject China. And I think in those countries, owning the bonds is very dangerous. In fact, I would argue that in those countries, bonds are going to be certificates of confiscation, and that rather than own bonds, say US Treasuries or German bonds or French OATs, you're much, much better off owning gold. So I'm very keen on Indonesian debt. I'm very keen on Brazilian debt. I think the opportunity set there is tremendous. Right now you're getting 6.5% real in Brazil in a very undervalued currency. Absolutely love that. But if you don't feel comfortable with EM debt, maybe you can go to Aussie debt. But by that point, you're probably better off in gold.
Thank you. Oh, fascinating. Bringing things from a more global down to a regional perspective, what's your take on investor interest within Middle East markets?
So look, this part of the world is obviously booming. Booming regions attract investors. And it's natural, just almost as natural as water flows downhill. The real challenge as an investor in this region, as an investor, your value add is that you have capital to bring to the table. Now, this happens to be the part of the world that is the most capital rich. So if I, as a foreigner, come to the Middle East and say, "Oh, I have money for you," they say, "Yeah, get in line, buddy. There's lots of money here." And this is reflected, of course, in the low yields on the region's bonds, if and when there are bonds in this region. So look, the interest is there. The returns, I think, basically reflect the risk, which is just not that high a risk.
And how does that investor interest correlate with emerging markets more broadly for Gavekal specifically?
Yeah, I think this is a super important question. For me, I mentioned one of the single most important macro trend is China leapfrogging the Western industry. Another super important macro trend, if you look at the top 100 largest cities in the world today, 69 are in emerging markets. In fact, pretty much all of them are in. I just flew over here from Hong Kong, where our headquarters is. Pretty much every one of them is in the flight that took me from Hong Kong to here. These are your 69 fastest growing cities, fastest and biggest populations. Now, the reason this matters is if you start off with the premise that economic growth really happens in cities. The countryside is great to hang out and it's great to relax, but growth happens in cities. So if you start off with that premise, for the past 3 or 4 decades, all of these cities in the emerging market world almost lived like independent islands. They were islands of prosperity, but with very limited links with one another, limited railroad links, limited canals, limited trade, limited everything. And this is what is starting to shift very rapidly. And so as you suddenly build the airline links and the rail links and the telecom links between all these various 69 cities, the boom in growth and exchange of ideas, exchange of goods and trade is going to be tremendous. A few months ago, I was in Delhi, just to give you an example. And we have an office in Beijing, so I need to fly to Beijing. Guess how many flights a day there are between Delhi? So Delhi, capital, 1.4 billion people. Next door neighbor, China, they do share a big land border. That's obviously been in the news in recent years. Beijing, capital of China, 1.3 billion people. Guess how many flights a day between Delhi and Beijing? The answer is 0.
Wow.
The answer is 0. So, and also between Delhi and Shanghai or Mumbai and Shanghai. Now, this won't stay 0. I'll bet my bottom dollar that in 5 years' time, the number will be 5, 6, 8 a day, because that's where growth is taking us. And so when you think through this, the ramifications of more exchange of ideas, more exchange of trade, cultural exchanges, etc., are simply tremendous. It's exciting, and I think that's part of our belief that the Indian Ocean is going to be the center of the world over the coming decade. That's why we've set up here, and I think the next 10 years are going to be very exciting for this part of the world and its integration within the broader emerging markets field.
Great, thank you. And Also, I've come across an investment framework that's exclusive to your organization. Could you tell us a little bit more about that and why that's good for your investors?
Absolutely. So I'm not sure it's exclusive to us, but we do like to manage portfolios. In fact, the first guy who came up with it, I'd love to claim origin of it, but there was a guy called Harry Browne in the 1970s and 80s. He was actually a Libertarian Party candidate. He ran against Ronald Reagan way back when. And he came up with the concept of the permanent portfolio. And the permanent portfolio, what Harry Browne explained is, look, you put 25% in gold, you put 25% in cash, 25% in stocks, 25% in bonds, and you can go to bed, fall asleep, knowing that you'll never get more than a 10% drawdown in any given year. And you did all the back tests on the US. But interestingly, if you do them for Germany, if you do them for China, if you do them for France, if you do them for Japan, you do them for any country, what you find is that real returns, annualized real returns, are basically between 3 and 5%, with never more than a 10% drawdown. So it's a sort of very safe way to manage a portfolio. Now, the reason this kind of works is that asset prices, and this is the basis of a lot of our work, asset prices are really determined by the interaction of changes in economic activity and changes in inflation. And that gives you 4 potential investment scenarios. You can have a deflationary bust when growth deteriorates and inflation deteriorates. You can have a deflationary boom when growth is good and inflation is low. And that essentially is the natural state of capitalism, because every CEO wakes up every morning wanting to do more with less. So deflationary boom is where we should naturally be. You can have an inflationary boom when there's high inflation, high growth, and an inflationary bust, also known as stagflation. Now, funnily enough, Browne's 4 assets each correspond to one of these 4 investment scenarios. In an inflationary bust, you want to be in cash. In an inflationary boom, you want to be in gold. In a deflationary boom, you want to be in stocks. In a deflationary bust, you want to be in bonds. So you can either say, I'm not going to try to figure out where I am in this 4 quadrants. I'm just going to go 25, 25, 25, rebalance, go to sleep. But of course, I think there's ways to optimize that, where you say, okay, where actually the risk of inflation is higher or lower, the risk on growth is higher or lower. So you can optimize between these four bases, and even within each of these bases, you can also sub-optimize as well. It's stocks. What kind of stocks do I want to own? Do I own tech? Do I own financials? Do I own consumer cyclicals? And so on and so forth. So that's what we spend a lot of our day doing. And I wouldn't say it's proprietary, because it's based on a lot of Harry Browne's work. And we've published a lot about it, and people are welcome to go to our website to see the studies that we've done, the papers that we've written to explain how we try to optimize. There's really nothing confidential or proprietary about it.
Thank you very much for coming in today and speaking to us. I've really enjoyed the conversation and learning more about Gavekal Wealth and your business.
Thank you very much for having me.
First of all, I'd like to thank again Louis for being our guest today, and please stay tuned for more episodes of DIFC Unplugged.